Hi, and welcome to the week ahead. I'm Tony Nash. Today, our special guest is Eric Barna. You would know him as Double Wide Cap on Twitter. We've also got Sam Rines and Tracy Shuchart today. So we're just joined by an amazing group this morning. As we wake up this morning, we see that the S&P has fallen kind of to 2680 or something like that. It's down about 1.7%. It's been that kind of week. And we thought it would be really good to get Eric in to talk us through kind of how serious our situation is right now. So in our key themes, the first one is how serious is the equity downtrend? And Eric's gonna walk us through that. We're then gonna look at the kind of the Fed's view of a better balance in the labor force. And Sam's written a bit on that, and we're gonna talk through that. And then Tracy's gonna talk us through more of the energy issues in Europe and some issues around moving manufacturing, potentially moving manufacturing out of Europe and where that'll hit the most. So guys, thanks so much for joining us today. Eric, welcome. And I want to, I know you're very technical, and I'm hoping you can bring us into kind of quite a lot about what's happening technically in markets right now. So really, how serious is the equity market downtrend? How long will it last? What will that downtrend look like?
Yeah, just to start it off, coming into this year, if you followed me on Twitter for a while, with really starting in the fall of 2021, you could, maybe it takes me or it takes the market a little bit longer to realize it, but we were heading out of this just support. 2021 was ridiculous as far as the market goes. I mean, it was just ridiculous. And Powell started signaling, this is kind of over. We got to kind of adjust things back. And so that's when I started thinking, okay, this is going to be is a different set of circumstances, but I was looking at just recent history of like a 2018, 2019 type of market through 22 and 23. And that's great for people like me because it gives us good defined ranges. It took a little bit longer than I thought to really test down into the pre-pandemic highs, the first real upshot from not the lows at 2100, but the initial push over that pre-COVID low, and then the retracement. So there's kind of a level, and once you release this on Saturday, I'll put the SPX levels. I'm looking at ES, the futures, and I back adjust contracts. So everybody's levels are going to look a little bit different, but 3165 to 3544 is kind of the meat of that first push over the pre-COVID highs off the 2020 lows, and then the retracement back in there. And I've been waiting for that retracement to kind of finish off. But, we put the highs in early this year, and this will be the third leg down. So first leg down was January through March, and then we had our March high, then we sold off again to the June low. We came back up to the August high, and this is the third leg down. So I'm looking for me, a dip down. We're getting close to that area, but it's not quite there yet. So, and when I say buy the dip, few people know that November 2020, I sold my house that I've had for 20 years. I banked the money, and it's been sitting, drawing ridiculously small interest, waiting for this when I put the money in. And this retracement here would get us down into somewhere in the 3,500, 3,300, and that'll give us a new low for the year. And, we're generally weak through the first week or so through August and then, or October. And if it's going to happen, you're going to get a bounce there. But you got to remember, you can kind of look at 2018 and that October to December, little bit of crash we had there. So, it's possible it goes lower, but, if I think there'll be good bounces at, like I said, that level, that 35.44. And I'll, like I said, Saturday, I'll put the SPX levels in the comment of that. Or the pre-pandemic high, which on my chart is 33.27, somewhere in that area, a good sustainable bounce. But, it's just kind of like yesterday, on a short-term basis, people were all excited about trying to buy that 72, try to buy that dip. And there's just nothing. There's nothing to tell you that this is over. The downtrend is, pick a time frame, and the downtrend is intact. And so the easier trade is still to the downside. You may get some tradable bounces in there, but for me, it's more be patient for that bounce and then sell it back down. And until that, confirms. Right now, my swing high is the August high. And there's a great deal of volume in that area, the 4,100, 4,200. If buyers can break back over there, I'll get bullish on the market again. But for now, I'm bearish. And of course, for me, being typically a day trader, I'll trade each way. But in the market's fractal like that. So, the same patterns on a monthly show up on the weekly, show up on the daily, show up on the intraday. So, but for me, my kind of bearing on my trade is the weekly, and the weekly tells me on rips, on bigger rips, you want to size and you want to short. If you are going to catch a technical bounce, you want to be small, you want to be out quick. So that's just kind of how I use the weekly. But for now, the weekly is solid trend down.
Great. Sam, do you have a question?
No, I'm just listening.
Just taking notes.
Yeah.
Okay. So Eric, so it sounds to me that we're kind of, say, you think we're going to bottom out, say around 3,400, we'll say, in a general range, and then we'll see things maybe up around 4,100. And if they're sustainably above 4,100, then we're kind of done with the downtrend. Is that fair?
Yeah, that's good. And it's we definitely don't have enough time to go through all of it, but just keep following me on Twitter. I'm going to post a lot more on.
Absolutely. Okay. Also,
but,
when you say
what I'm looking for is I look at my two big key levels every trading day is where is the trailing week volume? What was the most traded week or price in the last 5 days, and then the most traded price in the trailing month, the last 22 days. And
trailing trading week and trailing trading month.
Yeah. And so right now the trailing week is 37.80. It was yesterday 38.90. So volume is coming down. Volume is following price, and that's what I'm always looking for is where is value for the last 5 days, and as price moves down, is that value moving down with price? Because if you start losing that ability to put volume at the lows, you're going to get that really good snapback rally, and you're probably coming back up into the trailing week, and if you get over the trailing week, you look at your trailing month, because that's probably going to be the next target. Right now, trailing months, so if you're looking at most of September, the last couple of weeks in August, is at 4K. And, so, I mean, the snapbacks that we can get out of this market are dramatic, for me as a short-term trader, but it doesn't change my opinion that at some point I want to size back down. And so we're just not over with it now. So heading into, we'll see what Jay Powell does here. I guess he's speaking now, but that'll be my line in the sand for next week. Is that 37.80? On a, I'll be looking for shorts in that area to come back down on any kind of pullbacks, because right now the market is dreadfully short. If you look at breadth, if you look at the options market, we're sitting at like $1 billion in negative gamma right now. The VIX is high, 28, short-term VIX is 29, so there hadn't been a reversion yet. And that's kind of, and if you were watching yesterday on Twitter in my feed, when we started rallying yesterday, I was like, no, that's not the dip to buy. If anything, wait for, a key level like previous low and short the heck out of it, because it's coming back to 80, and that's what it did. But we haven't quite, we're inverted on the VIX, and we haven't quite recover from that. We haven't reversed back to a normal looking VIX. So until that happens, any price is lower. The 2022 low right now is my key target to the downside.
What would it take for us to get a normal looking VIX from your perspective?
You're going to have to start seeing, as time happens, you start decaying those puts. You get people covering those puts, and the dealers can get rid of the hedges that they have, and that puts it in a situation where I call it a dumb bid or a mechanical bid, where it's buy at any price. They don't care about my levels. They don't care where the trailing week is. And then the second part of that dumb money bid is the pension funds, the insurance companies who are trading more on risk and volatility. They have those volatility algos that run, and again, those are dumb bids. So I look at realized volatility. Where's the 3-month realized volatility? Where's the 1-month volatility? Trailing volatility, and who's in control? Right now, it's the short-term volatility. It's higher than the 3-month. And that gives you, it's great for me as a day trader, because it's going to give me good ranges intraday. Once the 3-month realized volatility is higher than the 1 month, then the market kind of calms down. And so you start looking at big days in that trailing 3 months. And as those days fall off, so say back in June, we had some really good 3% down days. And as those days fall off, and if you're not replacing them with big vol days to replace that volatility, the volatility will drop. That will set those pension funds and those insurance funds to buy. And it's just a dumb bid. They don't care if S&P is at 3,700, 3,800, 3,900. They're just playing volatility. And so, those are things that I look for me to go, okay, you know what, I'm going to put a chunk of money long here. And when I say a chunk of money long, it's usually a couple weeks, a week. It's not my retirement. I don't even know what the retirement fund is. Somebody else totally manages that. It's not my game. So.
Great. Tracy, do you have a question here?
No, I'm just listening too.
Yeah, this is great, Eric. We're not super technical. We don't really talk technicals that much. I think we'll start doing it a bit more, but this is great. So thanks for that. And I think it's all new for us, and really glad to hear all of this. So thank you for this.
Yeah. Yeah, just follow, for me, it's follow the volume. What is volume doing? Where's the most traded prices in area? If we're coming back up, like I said, that 3780 is a big key level. Buyers take that over. You're going to bring in that short term. There's going to be plenty of stops, over yesterday's high. We'll get you back probably into the 3800s, mid 3800s. And so that's, and I follow it on a weekly. If you look at the weekly now, the most traded price this week is below last week's most traded price. But what is the market telling you? It's telling you it's still in price discovery mode to the downside. We haven't found balance. And so I'm done. I'm a dumb day trader. It is really good.
I like it. I like it a lot. I think it's great. Okay, perfect, Eric. Thank you so much. Let's move on to some Fed talk. Like I think that segues really nicely into what you're talking about, price discovery. And one thing that Sam has published a lot about Fed. He does regularly, but he pretty much masterfully nailed the Fed's calls this week and the impact of the market. And so, Sam, do you want to talk us a little bit through that and a little bit about the labor markets, the better balance in labor markets that Chair Powell talked about in his discussion? We've got a chart up right now on what you call the switcher spiral. So job switchers and gains and VU. If you can explain, I know we talked about it briefly before, but what is VU and how does that play into the better balance in labor markets?
Sure. Yeah. So much like Eric, right, was saying that the market hasn't found a balance, neither has the Fed. And I think that's kind of critical to think about when we're trying to process what the Fed might be doing, how they might be acting, et cetera. So VU is vacancies to the number of unemployed individuals, specifically job vacancies. And when basically economists and Fed officials were looking for a reason that they missed the embedding of inflation and the overshoot of inflation, they found that there was a pretty tight fit between an elevated number of job openings and too few unemployed individuals. And the reason that is somewhat disconcerting for the Fed is pretty straightforward. Right now, if you switch jobs, you get paid a lot more than your old job, right? Those are really where the wage gains are. You're north of 8% as a job switcher, and there's lots of job openings. So the potential for a wage price spiral there is significant, right? It's not necessarily a theoretical at this point. It's there. That's the disconcerting part, right? If you have a wage spiral, then you have a price spiral, and then it gets really difficult to back away from it over time.
Sam, can I just stop you right there and say, is this VU concern, the wage price spiral, is that particularly in the US or is that global?
That's the US.
Okay,
that's
US only.
US. Well, I wouldn't say it's US only,
but particularly.
But
okay.
it's a particular phenomenon in the US.
Okay.
And I think that's really the only call it central bank that I would apply that framework to. But Powell made it very, very clear. I mean, not only did he state that job openings were too high, too unemployed. I mean, he called out VU directly, but he mentioned better balance a number of times, right? This is a Fed that is solely concentrated on inflation. It does not care how much pain there is in the labor market until you begin to have a decline in the vacancies to unemployed and until they see realized, not projected inflation come down. I mean,
do they factor in labor participation rate at all? I mean, it's labor participation rate is lagging, right? So that would make sense that there are more job openings than there are job seekers. Does that factor into the equation at all?
No, because the prime age is pretty much back to where it was pre-COVID. So, it's a bunch of old people and a bunch of young people that aren't in the labor force, and the Fed's going to completely ignore that. COVID did cause a number of older individuals to get out of the labor market. It was that simple, right? When you figure out that you don't have much time left and you got some money, you retire. It was there was a bit of a mental shift there. So I wouldn't say that is a significant factor. And if you back out to a normal participation rate, you're still sitting at about 1.6 to 1.7 jobs per unemployed, job openings per unemployed. So it doesn't take the number down to the 0.9 to 1 ratio that the Fed would actually like to see. And if you look at the numbers, you're looking at a 6+% unemployment rate to get the vacancy ratio back down. And so the Fed is willing to take some pain in the labor market. And I don't think that people are really anticipating it. And I don't think people are prepared for a Fed that really doesn't care about your labor market and only cares about its inflation.
They've already said they don't care about your house. So now we're learning they don't care about your job.
They don't care about your job either. I mean, he basically said that, right?
He did. I mean,
he
came. Yeah, his press conference, he stated it directly. And I made a joke that their forecasts were living in a unicorn metaverse about unemployment and inflation. I stick by that because you're not going to have a 4.5% unemployment rate. You're going to have closer to a 5.5 to 6.5% unemployment rate before you begin to see inflation break, and have it break in a way that convinces the Fed it's not transitory. The Fed does not want to have a transitory break in inflation. So I'll bring back transitory and annoy everyone.
Yeah. So if we dial it back in our discussion to what 6 or 9 months where you started talking about demand destruction, they're still on this demand destruction path, right? Because it's still really kind of the impacts of supply side inflation, not necessarily demand driven, right? Is it, or is the demand driven really only in the US? Because we see so much supply side inflation in the rest of the world.
Yeah, it's two-sided in the US. Right. You still have significant demand in the US, even with inflation running hot, and you have supply side constraints. So it's a two-sided problem in the US, and the Fed knows it can affect the supply side to a certain degree, not necessarily much. What it can really smack is demand. And so until that demand begins to come down, the Fed's not going to have accomplished its mission.
Okay.
So it is going to be a fun time.
Okay, so we hear from Eric that markets are discovering prices. We hear that the Fed is discovering its level. So really, on some level, nobody really knows what the destination is here. They think they do, but they don't, right? So the Fed
Correct.
saying 4.5 terminal rate or whatever is just like Eric saying 3,300 S&P, right? Kind of on some level?
On some level, yeah.
I don't think, everybody was talking about the Powell pivot as far as the market's concerned, and until and this is just my personal feeling, until you get to the pre-pandemic high, Powell doesn't care about the market. And I haven't, in July at his press conference in July, I was like, here we go. This is going to be it. I mean, I listened to it and I was like, damn, he's hawkish. And the market rallies. And I was like, and then I started hearing they're going to pivot. They're going to pivot, and then Dad came out, the last week in August or, that Friday before the last week and said, son, I ain't done. And
yep.
It's if you didn't take the clue from July, you certainly should have taken it from August. And then even in his press conference in September, he had the perfect scenario in the market to rally this thing hundreds of points. And all he had to do was say, hey, it's working. We're on our path. Everything's cool.
Month on
And
month, things are slowing down, right?
yeah,
Really had to
you
see.
know, everything's, you know, doing exactly what we thought it was. And he came out and he did it again. You know, we're not done yet. We're coming after your house, and we
Yeah, they
don't
are.
care. You know, we've got to get some people out of the workforce. You know, I mean, I don't know what else you need, you know?
Well, I said earlier this week, everybody is, whether they'll tell you or not, everybody is secretly hoping the Fed will save their portfolio, right?
Mhm.
Everybody's secretly hoping for that.
You know,
People,
I haven't done the math over, say, you know, from 17 to 22 or whatever it is, but my guess is before this is all over, that you know, that average gain you've had in your 401k over the last 20 years or so, you're coming back to it, you know.
exactly, exactly. Great. So Sam, just a question that's been in the back of my mind before we wrap this up on your side is, you know, we really started to see inflation accelerate last probably November of 21, something like that, right? October, November, somewhere in there. Is it possible we see base effects kick in at some point around inflation, and does the Fed care?
There's a possibility we begin to see base effects on headline with energy prices coming down, food costs beginning to moderate somewhat. But remember, shelter wasn't running last year at all, right? And shelter is a much larger component of CPI. It's a smaller component of PCE, but it's a much larger portion of CPI. So in a way, you're likely to see headline CPI, everything, begin to have those base effects take hold. But on core, you're in trouble if you're betting on base effects.
Okay.
That's the dynamic there. And the other thing is, it's been a much broader base thus far or this year on the month over month accelerations that you've seen.
Okay.
So that's something to pay attention to. The base effects are not here to save you.
Okay, good. Okay, I just wanted to get that out there because it does come up and it is in the back of my mind. And I've heard people say it, and I just wanted to make sure that's on the table. Okay, thanks for that.
I'll give you my my n=1 sample.
I love those.
So we moved down, you know, we sold the house, we moved down here to Houston for a couple of years and didn't want to buy. I should have, because I would have made a lot of money. But November is my lease renewal. It's my power to choose renewal and everything. And I'm looking at 15 to 20% on housing and electric this November. You know, so it's still ugly.
It's still ugly. So, okay, great. Let's move into, speaking of energy prices. Tracy, you put a tweet out earlier this week talking about the high natural gas prices pushing European manufacturers to shift to the US. So really interesting to me. I think we've seen kind of some China manufacturing start to shift to the US. Interesting to hear about European manufacturing shifting to the US. Can you tell us a little bit more about that? What's driving it, and what sectors do you expect?
All right, so we kind of have to go back to this fall in Europe when prices started spiking. We started seeing a lot of the smelting industry come offline, right? And that had, you know, because of high natural gas prices. Everybody forgets all of this started happening pre-Ukraine invasion, right? So this all really started, I mean, it was years in the making, but this really did start happening really in the fall, where we really started to see these effects. And of course, with high natural gas prices, you know, they have secondary and tertiary effects, such as, you know, if you can't produce fertilizer because that gas prices are too high, then meat packers are in trouble that buy the CO2 from the fertilizer companies. So we started kind of seeing a meltdown of these supply chains because of high natural gas prices. And then moving forward, you know, if we look, you know, we have almost 40% of fertilizer production is offline in Europe right now. We have iron, copper, nickel, aluminum, zinc smelters, and still stainless steel mills all offline too. Over 50% of their metal capacity is down right now. And these companies, once you, if you're a smelter, they're so energy intensive. I mean, you can't just restart those up again. I mean, it takes months to bring those back online. So what's happening is a lot of those companies already have or are considering moving to the US. They either have plants in the US or are planning to move to the US, just because our energy prices are a lot lower, and the cost after shuttering production, the cost to bring that up back online is very expensive. And of course, that's all of those metal companies. They're going to affect manufacturing. So I mean, Europe's in big trouble right now. I mean, the energy prices are too high. All their industries, it's huge supply chain, right? You have to know it just goes all the way down the supply chain. So their supply chains are going to be screwed up for a very long time, and they're not even better after COVID. The other issue is with Europe, they're going to have a problem with this. They're still focusing on, they're still tripled down on this green energy, right? So it's also going to force them to do is to rely on China even more, because China provides a lot of the materials necessary to build out, say, solar panels and windmills and things of that nature.
Okay, so where primarily is the industry coming from in Europe? Would it be Northern Europe, where a lot of these smelters and fertilizer plants and stuff are? Where is that generally?
A lot of those are, it's across 8 countries. So you have France, Romania, Slovakia, Slovenia, Germany, Netherlands, Montenegro, and Spain.
Okay. And so where would they go? Do they need places that are close to transportation, cheap energy, these sorts of things? Are those the priorities for them?
That really depends on, are they, it depends on where they are, right? I mean, you could essentially, build a plant like, kind of like the oil industry does. They go, they find wells, right? And then they build the town around it.
Right. Okay.
Right. And so, I mean, that essentially can happen too. I mean, it really has to, we haven't really seen any solid moves yet. It's more of a kind of a speculatory thing of this nature right now.
Right.
So we'll kind of have to keep an eye on that to see if indeed they do move to the US, because, I would also think that they're probably looking at Mexico, where labor's a lot cheaper. South America.
Labor's cheaper in Mexico, and power prices are deregulated in Mexico too. And that happened, 7-8 years ago. Yeah. So they are competitive on the power price side as well.
Right. So I would say let's keep an eye on that, because I mean, honestly, there are no solid moves right at this point.
Okay, very good. Any chance they'll move to Asia, or are they already too dependent on Asia?
I think they're trying to, I think after COVID, it kind of swoops them from Asia in general, even though ironically, they're going to have to rely on China a lot more after this.
Okay. Interesting. Definitely something to keep an eye on. Okay, thank you, Tracy. So guys, let's just go around real quick. And what are you looking for the week ahead? Eric, let's start with you. What kind of levels are you looking for next week?
Well, we'll see how we close this week. I'm still hoping we get under 3,700. We test that 2022 low. Really get a good flush in the market, and so I'm kind of looking at that 3650 if we can close it at the lows, and we'll see what we get out of if we get some short covering coming into the weekend. I don't know why you would, but if you do, where do we get to? But as long as we're under that 37.80, I'm looking for lower prices.
Okay,
Down
interesting.
into the mid
Great.
30s.
Tracy, what are you looking for on the energy side?
I mean, I think it's mostly the same. I think we have an OPEC meeting coming up, right? It's the end of September, beginning of October. So I think everybody's going to be focused on that. There's whispers of larger cuts, like not the token 100K that there was last time, so I'm sure that everybody's going to be focused. I'm sure there's going to be a million rumors this week.
Sure.
Up and down of OPEC job voting everywhere, but I think that most people involved in the energy industry are going to be kind of looking towards OPEC plus.
Okay. And is there a lot of fear in OPEC that crude's going to go into the 70s or 60s? I mean, or are they seeing things continue to rise? I mean, it's really a strong dollar story, but is that really the main fear?
I think, they would like, obviously they would like, higher prices. They would like closer to 100. Fundamentally, this market is still tight.
Okay.
So I think that's their main concern if they need to spook it. I mean, they're not making production.
I'm short on time. I'm really short on time.
Tracy.
Sorry. Sam, real quick, what are you looking for in the week ahead?
Oh, I'm just watching the dollar and what all the Fed speak comes out at. Right.
Still hawkish.
I think
still hot.
Basically, are they doubling down on last week, or are they trying to walk it back, and what that does with the dollar, and whether or not we can get the dollar to be looking a little peaky here.
Great. Guys, thank you very much for running time. Thank you so much. Have a great weekend and have a great week ahead.
Thanks.
You too, Tony. Thanks everyone.
Guys.